Hi, Assalamualaikum to Sir Azam. My name is Muhammad Shamim bin Faizal from class AC30. Today, me and my partner, Muhammad Daniel, will present about one of Assertion in auditing, that is right and obligation. There will be two part, two part in this video. The first part is me presenting about right and obligation, while the second part is Daniel presenting about audit scandal which involve right and obligation. The first one, I will talk about assertion. What is assertion in auditing? Assertions are characteristics that need to be tested to ensure that financial records and disclosures are correct and appropriate. If assertions are all met for relevant transactions or balances, financial statements are appropriately recorded. In other words, audit assertions are sometimes called financial statements assertion or management assertions. It means that management implicitly or explicitly claims that the value of assets, liability, incomes, expenses, and equity shown in financial statements are correctly measured and disclosed according to the applicable financial reporting framework. Management assertions are primarily used by the external auditors at the time of audit of the company financial statements. There are a few types of items in assertion in auditing, which is accuracy, completeness, occurrence, variation, right and obligation, and existence. In addition, there are three types of assertion, that is transaction level assertions, account balance assertions, and presentation and disclose assertions. For right and obligation, it falls under the account balance assertions. Alright, next I will talk about right and obligation. The right and obligations assertions relate to whether an asset is an entity's right and a debt is an obligation of the company at a specific date. For example, management asserts that the amount of lease capitalized on the balance sheets reflects the entity's acquisition cost of lease assets, and the lease payable represents an entity's obligation. In addition to existing, most assets must be owned before it is acceptable to include them in the financial statements. Similarly, liabilities must belong to the entity. Rights are always associated with assets and obligations with liabilities. This objective is the auditor's counterpart to the management assertion of right and obligation for account balances. However, physical examination is not sufficient evidence to verify their existence. The right aspect of the right and obligation objective is not applicable to liabilities. For assets, the auditor is concerned with the client's right to the use and disposal of the assets. For liabilities, the auditor is concerned with the client's obligation for the payment of the liability. If the client has no obligation to pay a liability, it should not be included as a liability. The next one is for right and obligation. Special purpose entities are sometimes created to be parties to off financial statement items. An example is a build to order lease transaction as it relates to SPEs. An SPE lessor retains title to a lease asset but relinquishes all control and risk to the lease, which assumes substantially all the risks and rewards of ownership. If the SPE is owned by the lease, the need for consolidation of the two entities, lessor and lessee, for financial reporting appears necessary. The auditor is concerned to determine that the accounting for the transaction reflects the substance regardless of the form it takes. Next, Daniel will be presenting about the second part of the video, which is audit scandal that involve right and obligation. Thank you.
Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is Muhammad Daniel Bukhari bin Abdul Hadi. Today I would like to present about the scandals related to right and obligations. The first scandal that we will discover is Miran Corporation. Miran Corporation was a Gen-On Energy subsidiary that is now owned by NRG Energy. On 2nd April 2001, the business was separated from its former parent, Sultan Company. On 3rd December 2010, the company was incorporated into Gen-On Energy. In December 2012, the company was acquired by NRG Energy. Miran Corporation is a global provider of electricity and energy-related goods and services. The firm owns and operates the power generation and distribution facilities. Miran also trades oil and energy-related goods, as well as managing the possibility of market price volatility. Miran operates 13 plants in the state of California, Georgia, Maine, Maryland, Michigan, New York, and Virginia, and has the capacity to generate approximately 10,300 megawatts of electricity. This scandal was take place on 2002. After the scandal happened, Miran had hired the law firm King and Spalding to review its 2001 accounting. Miran Corporation said it may have overstated various assets and liabilities. Miran Corporation has overstated a gas inventory by 85 million, account payable liability by 100 million, and account receivable asset by 68 million. The error was discovered in its 2001 statement during a consolidation of two accounting groups. The investing agencies involved in this scandal was SEC. The auditor also said the company internal control provided inadequate reconciliation of the risk report and the general ledger, uh, inadequate system integration and data reconciliation, and ultimately balance sheet discrepancies resolution. The auditor report to Miran that the deficiencies represent a material weakness to the company internal control. An internal review revealed errors that may have inflated revenue by 1.1 billion. Okay, the second company that we will discuss about the scandal is Enron scandal. Enron Corporation was an energy trading and utilities company headquartered in Houston, Texas. Enron was formed in 1985 as the merge of Houston Natural Gas Company and Internauts Incorporated. In 1995, the business was recognized as the most innovative business by the Fortune, and it made it a successful run for the next 6 years. In 1998, Andrew Fastow became the CFO of the business, and the CFO created SPVs to conceal the financial loss of the Enron. Enron was employed approximately 2,000 people before declaring bankruptcy on 2nd December 2001, and was one of the world's largest energy, natural gas, communication, and pulp and paper companies, with claimed sales of nearly 101 billion in 2000. Enron scandal. Enron complies illegally use of the books partnership to conceal debts worth more than 1 billion. It established a special economic vehicle in order to conceal its enormous debt from its external stakeholders. The special purpose vehicle was utilized for concealing realities of accounting rather than focusing on the operating result. Some of the assets which has increased marketable values have been transferred by the company and it has taken cash or not in return. The stock was then used by the special purpose vehicle to hedge an asset on Aaron's balance sheet. It assured that a special purpose vehicle reduced the counterparty risk, and Ron assumed that the price of the stock will continue to appreciate and that it will not deteriorate or fail as hedge funds. The primary threat was that the special economic entities was capitalized with only the stock of the corporation. If the corporation was compromised, then the special economic entities won't be able to hedge the deteriorating market price of such stocks. Iran Corporation has a major conflict interest in the special economic purpose vehicle. That's all from me. Thank you.